You're listening to Seattle Real Estate Podcast.
Welcome back, everybody. I'm Sean Reynolds, the owner of Summit Properties Northwest, Reynolds & Kline Appraisal. And today I've actually got a guest on the podcast. His name is Mr. Dan Chapman, and you've probably seen him before. And he is Summit Properties Northwest. He's our kind of go-to mortgage guy. And everybody knows that the real estate market has been going crazy, which means prices just keep getting higher and higher and higher. One of the questions that comes up all the time is, how much money do I need to buy a home? How much income do I need? How much of a down payment? What does that look like? That's what we're going to cover today on today's podcast. Amongst a number of other mortgage-related things, we're going to talk about interest rates, where they're at, where they're headed. Bunch of good stuff with Dan Chapman. So Dan, thanks so much for being on the podcast again.
Thanks for having me, Sean. Good to be back.
Yeah, you bet. You bet. So one of the things that we're talking about is questions that come up that you answer all the time. And so that I don't have to answer them, you don't have to answer them, they're out on the podcast, is what does it actually take to buy a home? So let's kind of walk through the scenarios of what that looks like. And you've given us three examples here, right? Mm-hmm. So let's start with the first one, and that is if you were to buy a home for $350,000, walk us through some of the scenarios that a buyer is looking at. We're going to start low, work our way up. We're going to go 350. We're going to go 350, 500 and 1.2 million.
So 350 in this area is going to be a condo.
Yep.
And so, you can put as little, if you're doing conventional, which is the most popular loan program, as most people know.
As opposed to like an FHA.
As opposed to an FHA, we would definitely want to go conventional unless you didn't qualify. Then you go FHA. But 3% down, you can put as little as 3. So I have that here. I have 5%, 10%, and I have 20%. So different ranges. Okay. And the rates right now on a 30-year fixed about 2.75 with no points. That's about, if you got decent credit, that's about where you're going to fall right now.
Let's talk about that for a second. How low is 2.75?
It's just insane. I mean, we're talking, I've been in the business 19 years, and this is the first year that we've been below 3%.
Under 3%.
Yeah, 19 years.
Unheard of.
Yeah.
Literally.
Yeah, so their buying power is amazing right now. While prices are certainly high, and I don't see them going down, so if you wait, you're going to miss out. But the buying power is really high because rates like this won't stay low forever, obviously. They can't.
Right, right.
So.
Yep. And we're kind of doing this podcast because everybody's got somebody, whether it's your grandkid, your kid, yourself, somebody's got somebody that's like, oh man, houses are so expensive, but I don't really know what it takes.
Yeah.
And that's why we're kind of going through this and we're breaking this down. So let's keep going. Okay, so 3% down on a $350,000 purchase.
Yep.
Down payment's going to be $10,500. That's just the down payment without your closing costs.
Yeah, and you're going to have probably about, depending on taxes for the property and when you close, figure $7,000 right there. Okay. So you're talking about 17.5.
Okay. Here you've got 18.5. And what would your so under $20,000 for a $350,000 purchase?
Yeah, for sure.
What would your payments be on that?
At 2.75, I figured $300 a month for HOA dues. That's a pretty average.
Okay.
Could be more, could be less.
Yeah.
I mean, there are some townhomes out there with no HOA dues, but in this price range, probably not. But,
right. Yep.
So principal and interest, $1,386, all in payment with taxes, insurance, PMI, HOA dues, which HOA dues are paid separately, but just all in monthly expenses, $2,166. Okay. With 3% down. Okay. And then with 5% down, you're.
Let's run through those numbers again. So at $350,000, you're going to need a total down payment of just under $20,000.
Yeah, I'd say closer to $18,000. Yep.
Yep. And your total payments out the door are going to be a hair under $2,200 a month.
Yep.
Okay.
Yep.
Okay.
And at 5% down, you're going to need closer to probably $25,000 all in with closing cost.
Okay.
Obviously, 5% is $17,500, and then at 2.75, your principal and interest is $1,357. Your total payment with everything and HOA dues, assuming $300 a month here, $2,077.
So by putting an extra 2% down, you're dropping your payment by, call it $100.
Yep.
Not that much.
Yeah, not a lot.
Right.
Yeah, and then 10%. You're going to need roughly $43,000 with closing cost.
Okay.
and then you're talking about a total payment of under $2,000, so about $1,975 a month, call it.
Okay. So we go from like $2,000 to $2,100 to $2,200, depending on how much you're putting down. And your down payments are going to range from, call it $18,000 to $26,000 to $43,000.
Yep.
And that's on a purchase of $350.
Yep. And that's assuming about $7,000 to $8,000 in closing costs. So, you know, you can be a little less on closing costs if the taxes on that property are pretty cheap and you're closing in a month where we don't have to collect a full 6 months taxes.
But you're talking maybe $1,000.
Yeah, maybe $1,000.
Tops.
Yeah, exactly.
Otherwise, the closing costs for all these are going to be about the same.
Yeah, your what they call your non-reoccurring closing costs, so title, escrow, appraisal, and lender fees.
Yep.
Those are about $4,000, and then you have your prepaids, your reserves for taxes and insurance, and those, depending on when close, could be $3,000 to $4,000. So
that's the breakout on kind of your closing costs, which are about $8,000 in this case.
Yep. Right about that.
Yep. Okay. So that is. You've got one here for 20% down, but I think we kind of get the trend there on 350. Let's jump up to 1.2 million.
All the way.
Let's just go right to the top, right off the bat.
Yeah.
Let's take a look and see what that looks like. And I just kind of wanted to give people a comparison because I figured 350 is entry level, 500 is kind of mid-range, 1.2. And here in Seattle, 1.2 in a lot of areas, that's a starter home.
I know. Kirkland, Bellevue.
Yeah. We're using this as a luxury example, and for a lot of viewers and listeners out there, 1.2 is just mind-boggling. Yeah. But in the Bellevue market, it's like a starter home.
Yeah, it's not something.
It's not something great.
It's really nice.
No.
So, 1.2 jumbo loan now, 20% down minimum.
So jumbo as opposed to conventional. Tell us the difference there.
Yeah, so jumbo is just stricter on everything, stricter underwriting guidelines, stricter on debt to income ratio. They look at your income more closely.
And why is that? Why are they doing more scrutiny?
You know, that's a good question, Sean.
I mean, technically, it's risk.
It's a little more risk because they're lending you more money. So that's what it comes down to: is they're lending you more money.
Yep.
They want to make darn sure that
we're going to put you under the microscope.
Yeah, exactly. Yeah, especially if you're self-employed. If they're self-employed and you're getting a jumbo loan, they're going to dissect you.
Right.
So I tell my clients, you're
that's because they know you might be fudging.
You're getting a lobotomy. So 20% down on 1.2 is a loan of $960.
Okay.
You know, I put total monthly principal and interest of a little over $3,900.
Okay.
At 2.75 on a 30-year fixed.
Okay.
Jumbo rates are very similar to conventional.
And how much is your down payment? So 20% down on 1.2, 240 grand.
240, correct. Yeah.
Yep.
So
$250,000 down.
Yeah.
Cash.
Yeah. So on a loan of $960, your payment's only about $4,800, depending on exactly what your taxes and insurance are.
Okay.
So $4,800 to $4,900, it could be a little
It's
variance
only
there.
$4,800, but that's a lot more money than a lot of people make.
Yeah. Yeah, you got to qualify for that,
Right.
Yeah. So,
Yep.
if you're working at, Amazon or Facebook or Google, in your software engineer, you can probably afford that if you don't have a lot of debt, And
we're going to get into that.
Yeah.
Hey, I make $200,000 a year. How come I can't afford $1 million home?
Yeah.
That's a very real question. We'll get into that in a sec, but let's get through this. So, all right. So 1.2, you got a loan amount of $960. You've put down $240,000 down payment. What's your closing costs are like $10,000?
Yeah, on that about $10,000. That's about right. Yeah.
So it doesn't go up that much on your closing costs from a 350 purchase to a 1.2 purchase.
Yeah, I mean, the lender fees and all that are the same. So it's just a matter of you're gonna have a little higher title fee and a little higher escrow closing fee, but that's about it. Other than that, the only difference is what they call reoccurring for collecting taxes and insurance. Those are a little bit higher too.
The points that you're going to pay to your lender guy.
Yeah, if you're buying the rate down, I'm just doing no point scenarios here because that's what a lot of people like.
Okay.
Yeah.
That means the rate's a little bit higher.
Yeah, if you wanted to pay, say half a point, you might get an eighth lower in rate. If you paid a full point, you might get a quarter lower in rate. Just depends.
So let's break that down. So a point on a purchase price of 1.2 with 20% down, a point is $9,600.
Yeah. Yeah.
So almost 10 grand. That's 1%
Yeah.
of the total loan amount.
Yeah.
And that's going to reduce your interest rate by how much?
By about 0.25%. I mean, sometimes it'll be less than a point. Pricing changes daily. It could be 0.75%. 0.75% times the loan amount could drop your rate 0.25%. So it varies.
And that is because, and I am not a mortgage guy, but I have been doing this for a couple of years now.
Yeah.
And so when you're talking about buying a point, buying your rate down, you are basically purchasing that rate today, guaranteeing the lender their return up front.
Yeah.
You paid them.
In exchange for a lower monthly payment. So,
right.
And usually I do a spreadsheet that says, hey, it's going to take you X amount of years to make up for that.
Right.
So, and sometimes it's 5 years, sometimes it's 7 years, sometimes it's 10 years. So it just depends if it's worth it or not for you. I'd say 80% of the purchases I do are usually with no points, right around there.
Because people don't really know how long they're going to be there.
Hard to forecast past 5 years. I look at things and I go, 10 years from now, who knows? 5 years from now, I'll probably be in that house. But, 10 years.
But you don't know. Do you want to spend the extra money, buy the rate down?
Yeah.
All right, so let's run that through again. 1.2 million, you need $250,000 down roughly. Mm-hmm. You need 10 grand in closing costs. So you've got a total out of pocket 250 grand, legit. And your payments are going to be, call it 4,800. Mm-hmm. So those are your raw numbers.
Yep.
Okay. What kind of income would you need to afford 1.2 million with 20% down?
Well, we go off if you're a W-2 employee, we're going off your gross income.
Yep.
So
W-2 meaning you are not self-employed.
Correct. You work for Amazon or Facebook or Microsoft or somebody.
You're an employee.
You're an employee.
Yep.
So if you don't have a lot of debt, let's just say you have, revolving credit cards that you pay off every month, and maybe it's $100 a month and you don't have a lot of debt. As long as your debt to income ratio is below 43%, you're going to be okay. So if you make, say, $150 a year, $12,500 a month gross, you're gonna qualify for that. It's going to be tight, but you're going to qualify for that.
So let's break that down. So 4,800 divided by 12,500 is roughly 40%.
Yeah, that's about
and I'm
right.
Totally guessing here. Tell me what that is.
Yeah, 38.4%.
Ooh, I was off by 1.6%.
You were darn close.
Yeah.
So that's fine on a debt to income ratio.
Yeah.
If you think you might be getting a car down the road, and it's $500 a month, then you're probably spending a little too much.
How about you've got a $250,000 purchase, and a week before closing, you go out and buy a $40,000 car with 10% down.
Yeah.
What does that do for your home purchase?
Yeah, that declines it. Yeah, most likely. Yeah, that's a problem.
And that is a theoretical situation, a hypothetical situation that happened to us 2 months ago.
Yep.
It's like your guy bought a car. What was he thinking? Well, he needed a new car for work.
Bad timing. Bad decision.
So the bottom line is if you're in the process of buying a home, don't buy anything. Don't have any credit inquiries.
Yep.
And why is that?
Well, I mean, you don't want to change your financial situation. You don't want to change your debt to income ratio, obviously, during the home process, home buying process and approval process. And then as far as, I mean, you can't add any debt. It's just not good. You don't want to do that
because you're going the wrong way.
Yeah, you're going the wrong way. So wait, talk to your loan officer, talk to me. We do send out an email that says, do not go out and make any major purchases, and it's in bold print.
Right.
If I'm having a conversation on the phone with somebody and it's kind of tight on their debt to income ratio, I will mention it. If their debt to income ratio is not super tight and they went out and bought a car, and hey, I'm sorry I didn't mention this, but I did buy a car. My payment's $500 a month, and my debt to income ratio is 21%, and I have $800 credit score.
It's irrelevant.
Fine, we can add that debt. We just get proof of what you're paying.
Yeah,
no problem.
You're fine.
But
it's when you're really close is what you're talking about.
Yeah, and I've had some people do that, and I mean, don't lose your job. I had one this year that.
Don't lose your job.
We actually sent docs to escrow. We sent docs to escrow, and the last thing we do is verify employment. When we send docs, we call to make sure they're still working there, especially with COVID. And he lost his job, so he didn't get the house.
And this is right before closing.
Like 3 days before.
3 days before closing.
Yeah.
That is another great question. I've had a lot of brokers call me and say, "Hey, Sean, My borrower just had a verification of employment, and we're closing in 2 days. What is up with that?
Yeah.
And that's becoming more of a thing, especially with COVID, because some of these people employment is spotty, or business goes out, nobody knows, the job changes.
Yeah.
And so the lender is basically saying, hey, we just want to make sure before we give you this $960,000.
Yeah, they'll do that like 2 or 3 days before closing now. It used to be, maybe a week before closing, it would be done, once we're getting final approval, but now it can be all the way up to the day we send documents.
Right. And you know what? If I were a lender, I'd do the same darn thing. I want to make sure, hey, up until the last minute, can these people afford it? Because if they can't, I got to take this home back.
Yeah.
I would say that during a pandemic, it's going to be hard to sell that home. But guess what? It's not.
Yeah.
But still, if you're a lender and you got a minimal down payment by a borrower, you want to know they can make those payments.
Right, for sure.
Because this $4,800 a month, that's a big nut.
Yep.
I mean,
yeah, absolutely.
That's a lot of money.
For sure.
So Dan, we did the high end 1.2.
Yep.
We did the low end 350. We're going to do something kind of in the middle there at 500,000.
Okay.
Run us through that. So what does that look like?
So you can put as little as 3% down.
Yep.
Again, 2.75, 30-year fixed with good credit. Principal.
Let's talk about good credit.
Yeah.
What does good credit look like?
740 over.
Okay, 740 credit score and up.
That's excellent credit.
Okay.
You could still get that rate at 720, but it may not be no points. It might be like cost you a small closing cost extra.
Say you've got a 650 credit score.
Then you're not doing a conventional loan.
Okay, you're going to do FHA?
Yeah.
If you can.
Yeah.
If it's qualifying within the loan
because
limits.
the PMI with that credit score would be like $700 a month.
Okay, and if you have a 600 credit score?
Then you're not getting a loan.
So you need to work on your credit.
Yeah. You need a 600 to get an FHA loan.
Okay.
So.
Okay.
And even at that, you really want to be at 620. You could get one of 600, but conventional kind of is the barometer is like 680. If you're over 680, you go conventional.
You'll be able to figure something out.
Yeah.
Okay.
Yep.
All right. So sorry about jumping in on that one, but I thought that was important to kind of go over credit scores, because you and I always talk about good credit scores, 700 something plus.
Yeah.
But then a lot of people, and especially a lot of people probably watching this one, are like, okay, my credit's not great. I know I need to work on it. It's holding me back from buying. Mm-hmm. On top of the fact, I don't have enough money, nor do I make enough money. So those are kind of the three major factors. Mm-hmm. Your income, your credit, your down payment.
Yeah, income, assets, and credit, three important.
Yep. Okay, so $500,000 purchase, 3% down, good credit.
Yeah, 15K down, and you're talking about $8,000 in closing costs.
Yep.
So about $23K you need, and your total payment, assuming no HOA dues. This is a single family house or a townhome with no HOA dues. Just under $2,700, $2,693 on this form, with taxes and insurance. And PMI.
That does not seem like a crazy number.
Yeah.
And it's not?
Well, I mean, you're getting into a property with 3% down. So if you look at the 5% down scenario, all in with closing costs and everything, you're about $33K with closing costs in the down payment of 5%. That payment is 2.75 is $2,568 roughly. So call it 25 and a half.
So not even $100 less than 3% down.
No, it's about 130. About 130, yeah.
Oh, you're right. Yeah, 2693 versus 2568.
Yeah, so
okay.
And then you get to the 10%. That's when PMI is really pretty cheap, 10% to 15% down.
Okay.
So that factor at 10%, you're talking 50K down plus closing costs, so 58 all in to get into that 10% down with closing costs. And you're on a 30-year fix, 2.75. You're just over 2,400, 2,420. Yeah.
All in, 2,400.
Yeah, so that's not bad. There's $145 cheaper than the 5% down.
Okay. So let's recap. So on a $500,000 purchase with 3% down, you're looking at $23,500 for total cash you need, all the way up, and then 5% down, you need 33, call it 34 grand cash. 10% down, you need closer to 60 grand cash. And your payments range on the low end from 2693 on the 3% down to middle of the range. 5% down is, call it 2600, and then it drops down to 2400 when you put 10% down.
Yep.
So those are your your numbers. Now, all of these are not conventional, correct? I mean, they're 10% down conventional, but anything under 20%, you're going to have mortgage insurance.
Correct. Yes. Yeah. Anything under 20%, you have mortgage insurance. And, mortgage insurance is based on, they're really pricing it based off your credit score, number one. And they actually do look at debt to income ratio too, because if you're over 45% on your debt to income ratio, there's a hit there. So you want to get the best mortgage insurance rate, you want to have good credit, at least 740, and then keep your debt to income ratio under 45%. And then the other factor is how much down payment percentage wise are you putting? There's price hits at 5%, it's more expensive. And then if you put 10%, it's less expensive. And you put 15%, it's less expensive. So.
And why is that? So you're putting 10% down, which is a lot of money on this $500,000 purchase. It's almost 60 grand total.
Yeah.
Why is the lender making you do mortgage insurance on anything less than 10%?
It's just more risk. There's more risk there that if you that people are less likely to walk away from a home if they have financial trouble, if they have a lot of equity in it. Because they were like, man, I got 100 grand equity in it.
I put 100 into this.
I'm not walking away. I'm going to sell it. As opposed to just saying I'm out of here.
And they've got the room to sell it is the bottom line.
They do. Yeah. Yeah.
They've got that's one of the things that I've been reading about is that we thought with all the mortgage forbearance that was going to go on with the whole coronavirus shutdown and everything, because the housing market is basically shot up straight to the moon.
Yeah.
Appreciation wise. When all of this forbearance stuff kind of finally comes to fruition, when all these things are over, there isn't going to be a lot of foreclosures because everybody's going to have enough equity.
Totally different than 2008 where values plummeted and people lost 100 grand on a $500,000 home in value. They're like, I'm out of here. I'm upside down.
Yeah.
Now you got equity, so PMI just protects the lender against the chances of that. If there was a loss, they would get certain percentage of their loan money that they lent back. So
they're basically making you, as the consumer, as the buyer, pay for insurance. On their investment and kind of your investment.
Yep.
They're making sure everybody's got some skin in the game.
Everybody's covered. Everybody's got skin in the game. Exactly.
Yeah.
And it's not that hard to get rid of. You can get rid of it,
Well, yeah. So how do you get rid of it?
I mean, the easiest way, obviously, is to refinance. But if it makes sense to get rid of PMI, I'm doing a lot of those right now. A lot of people that bought in the last couple of years have PMI. Their rates at 3.5% to 4%. They want to get a below 3% rate and get rid of their PMI. So that's number one way.
And that happened. So 3 years ago, now the home is worth a bunch more. Mm-hmm. They've got the equity. They've got 20% equity, 20% down, however you want to look at it. They've got enough of a cushion where the lender is like, yep, you don't need PMI for that.
That's right. So that's number one way, refinance. Number two, pay the loan down below 80%. Lenders are required to drop it when you paid it down to 78% loan to value based off your purchase price. So say you bought the home 4 years ago, you've now paid it down, you put 10% down 4 years ago, and you've now paid it down to under 80% based on what you paid for it. They're required to drop it at the 22% equity, so 78% of the value. Loan to value. They're required to drop it. So that's number two.
Okay.
And number three, and this is the hardest way, it can be done, but you usually have to wait 2 years. You have to be in the PMI and in the loan for 2 years, and then you can submit to the lender, hey, I've paid my loan down, but look at the value. Here's the assessed value, and they can do a value search on their end, or they can make you pay for an appraisal.
Yep.
And there's a form you have to fill out, and then they can drop the PMI that way.
And I've been involved hundreds of times on the removal of PMI from the appraisal end. Hey, my lender said I needed an appraisal from a certified appraiser. appraiser, can you help me out?
Yeah.
Yes, we can. Whether or not that value is going to be there,
Right.
I won't know until the appraisal is done.
Exactly.
And then you've spent $700, $750, whatever.
Yep.
In other markets, it might be as low as $400.
Yeah. Actually, Southern California, it's about $450, $500.
Is it?
Can you believe that?
Yeah, I can.
Yeah.
Yeah. Everything's weird in
It's
California.
just weird.
Yeah. No offense to all the fans
But,
in California.
everything else is expensive there. You know, income tax and, state tax and all that jazz.
So you moved, speaking of that, you and I talk a lot about the exodus from California.
Yeah.
You moved from California to Montana.
Yeah, as you know, I was born and raised here, lived in Kirkland for 27 years, started in the mortgage business here, lived in wife was dying for a son about 12, 13 years ago, and we had relatives down there and all that stuff. So we lived down there for about 12 years, and then now live in Whitefish, Montana. Actually, I've been wanting to get out for years.
So was your primary residence, was it officially in California?
Till 2018, yeah.
Okay.
Yeah.
So you paid that state income tax.
Oh, yeah.
How was that?
It's terrible. It's terrible. It's a ripoff. Jeez.
Because you don't get anything for it.
Yeah.
I mean, like Washington doesn't have one.
Yeah.
And we're
and that's a big reason people move here, because they're like, I'm if you're making good money, you're saving 8 to 10% in taxes by moving from California to Washington. And then businesses, right? The business taxes here are less expensive.
Yeah.
And
arguably we got better bang for our tax dollar. Not necessarily in Seattle.
Yeah.
Because nothing's going on there.
Nothing's working there too well right now due to the Seattle.
Yeah, that's crazy.
Yeah.
Okay. Well, thanks for those examples. What are, on a daily basis, you deal with all kinds of stuff. What are and that's to do with people either getting a refinance or purchasing a home, getting them a loan. What are the top couple of hot topics right now? What are the things that you are consistently working on to overcome that would be super helpful for people who are either looking at buying a home, looking at refinancing? What are some things that would help them out as far as this whole process goes? Yeah,
I mean, if you're a W-2 employee, it's relatively simple to dissect your income and figure out that and what you qualify for. That's not that hard. I guess the next thing would be if you're self-employed. Somebody, I got a call the other day, some client of mine, hey Dan, I want to buy, a house for, $1.3 million. When they were thinking about 900 to $1 million before. Now I want to go up to 1.3. Well, self-employed. Well, you just don't claim enough income. Your net income on your taxes, whether you're filing a Schedule C, net income at the bottom there, we look at that. If you're not filing a Schedule C, but maybe you file a K1, so you're filing what's called an S Corp, and you file that K1, we use that net income on the K1, and then if you pay yourself W-2, we combine those two income. You have to, plenty of people, I mean, I get it. You don't want to pay an extra $100,000 in taxes to the IRS. Neither do I. So you find loopholes and you write those off. Well, it can hurt you in the mortgage world because maybe you're taking home $25,000 a month and you're self-employed, but you're claiming 15. So you're not getting qualified on what you don't claim.
So a lot of people are like, hey, I make a lot of money. But then when you look at their tax return, you're like, you make good money, but you don't make the great money you thought you did based on your tax return, which is what we're submitting to the lender. That's what they're actually going to look at. And that's where a lot of self-employed people are like, oh, yeah, that's when it's not good. When you go to buy a house or you need to qualify, your income comes under scrutiny.
Yep.
And that's where you get hosed. But do you want to pay a lot in taxes? Do you want to go in really far in debt and buy a $2 million home, whatever it is?
Yeah. So I get that scenario quite a bit.
So you work a lot of your business is here in Kirkland, Washington.
Yes.
What is the average loan amount that you on a purchase? What's the average loan amount?
Loan amount, not purchase price.
Yeah.
Probably 600.
Okay.
Yeah.
And that's a purchase of
I'd say 750
median housing
price.
price.
Yeah. I mean 750 right around there is probably the average purchase price that I deal with. I mean, I definitely do a fair share of jumbo. This year is a little down because of COVID, but I'd say about 750, 800 average purchase price.
750 with 20% down.
Yeah, I mean, you could put less, but yeah.
Something along those lines.
Yeah.
How many purchases do you do over $1 million?
In a year?
Yeah.
This year was less than last year, even though this year was way better for business because, the jumbo market for COVID was shut down for a couple months.
Right.
2-3 months.
Like literally. So,
I mean, some lenders I know, my brother still can't do a jumbo loan.
Wow.
Yeah.
And where he's at
Caliber Home Loans. Yeah.
Are we supposed to say other?
I don't know. But we're still doing them, just 20% down.
Okay.
I this year, I don't know how many I did. I'm going to say 20, and then last year would have been more than that. Jumbo purchases.
Because I remember having you on the podcast, and we were like, "Wow, we've got one lender in the jumbo market, Salal Credit Union."
Yeah.
Remember that?
Yeah, that was back in
March,
April.
March,
April. Yeah.
There were
because they underwrite to conventional guidelines. They don't underwrite on jumbo guidelines.
Okay.
But their loan limit is $1.5 million.
Okay. So they were reducing their risk. They're still doing jumbo, but they were reducing their risk.
Yeah.
And you got to have a monster down payment.
Yeah. And so I did a lot of loans in that time period. Not a lot of loans, but I did enough where you want to buy for, 1.2 million, you got 20% down. We did a first for the conventional max, which this year was 750, and then we did a HELOC for up to 500K. You could do that.
And a HELOC being a home equity line of credit.
Home equity line of credit.
So basically borrowing on
so you could, you could buy for, 1.5, and if you had, 20% down, you could do a first, and a first and a second for 1.2 million.
Right.
And not have a jumbo loan.
Right.
Not strict underwriting, really easy.
They made it happen.
Did a bunch of those for a few months.
So we had a time period of maybe 3 months in there.
Yeah, about 3 months.
Where there was hardly anything jumbo going on.
Yeah.
Jumbo buyers were out looking, and they're like, even if I find a home, I don't know if I'm going to be able to find a wholesale lender that my mortgage broker can broker this deal to.
Yeah.
So, let's jump from, we've talked about kind of the high end. Let's say you are a first-time home buyer, or you've got somebody in your life that's a first-time home buyer. They don't make enough money. Mm-hmm. They've got subpar credit, and they don't have a huge down payment. What are some things other than the obvious of get a higher paying job?
Yeah, that's good. Yeah.
Or get your credit going, talk to a credit counselor. Mm-hmm. But you probably don't have money to be talking to a credit counselor if you're already kind of on the lower end. What are some things that you as a mortgage guy can tell people who are trying to get a home or are thinking about it or are struggling coming up with the numbers? What can they do?
Yeah, I mean, I'd say, the income thing might be hard to work itself out for some people because they're strapped. They can't get in a job for whatever reason, so their income is stuck right where
they're in an industry where they don't make a lot of money.
Yeah, so whatever that is, put that aside. Income is what it is. Can't, unless you can work some overtime. But credit, you can always change. You can always fix your credit. So if you've got credit card debt stacked up, paying those things down to where you're not maxed out is going to help your scores. So get your credit score boosted. You can go to annualcreditreport.com once a year, get a free credit report. Check out that. There's plenty of apps out there like Credit Karma if you want to monitor your credit. Credit Karma is not an exact rate. not an exact score. It's actually not a real FICO score. It's called a Vantage score, which is an estimate, but it's usually pretty close. And it'll tell you, hey, if you did this, you can get your credit score up to this. So that's kind of a good gauge. It has 2 of the bureaus out of the 3 on there. Now they do market to you and things like that, but you can turn the notifications down on your phone and you can monitor your credit that way.
I've used Credit Karma in the past because I had crappy credit coming out of the Great Bust.
Yeah, like a lot of people.
Yeah. Foreclosures, short sales, had too many homes.
Yep.
In an industry where I was making no money.
Yeah.
And it was just a bloodbath, and I lost basically everything.
Yep.
And so getting credit, I went to a credit counselor and paid them a bunch every month. I think it was $175 a month.
Yeah, I've got some good ones that are in the Seattle market that are about $100 a month. And usually about 3 months, you're good. So $300 to get your credit off, and they deal with it for you. So if you got a little extra money to spend, get
totally
your credit.
Worth it. For me, it was wildly worth it.
Yeah, especially if you got like a collection on there and you can't get it off, or some late payment that really wasn't late, or you shouldn't be on there, anymore.
And they point that out to the credit bureaus, and the credit bureaus either have to respond and say, "Hey, this is
they got like
legit."
45 days to clear it up, or if you send them a dispute letter or dispute it, and they can't figure it out, then they got to remove it.
They take it off, and that's where you get your bang for your. That's where your $175 goes towards. My credit score. I can't remember what the numbers were, but I was really pleased. I was like, "Wow, I am actually able to buy something again. This is crazy." And you'd think, okay, a guy owns a couple of real estate companies, he's going to be loaded, it's going to be fine. I mean, there were so many guys like me that were just overextended because we thought the housing market was just going to go to the moon. Which it's doing now.
Which it's doing now, but just, 10 years later.
In my early 50s, I'm like, it's crazy how that happens. So the moral of the story is you can get your credit back up.
So that's important. Definitely credit.
Right. Saving for a down payment. What do you say there?
There's apps for that too, Okay. My wife's got one. It's connected to one of our checking accounts where it basically takes a certain percentage out every week out of your checking. So it just pulls it out and puts it into a savings for you. So it's kind of like a forced savings. She just uses it for whatever, buy something for our kids once in a while. I don't know.
It goes into a savings account, separate savings account.
I mean, otherwise, you just, obviously got to save. You got to get a money market account that has a decent interest rate and transfer money from your checking to your savings and ignore it and let it build up. But whether that's for you, whether that's $100 a month or $1,000 a month, you got to get some sort of plan together. What can I cut back on something? Do I need to go out to eat twice a week? Or can I do once a week?
The latte factor.
The freaking lattes around here are $4 or $5.
Yeah, I know. Right.
You do one of those a day. Do the math, man. That's $150 a month.
That's that whole Dave Ramsey, thing.
That snowball type deal.
So when we're talking about let's look at the low end, the $350,000.
Yeah.
Total cash to close $18,500. I mean, that sounds like a lot of money, but if you've got any kind of income at all, and if you have maybe a partner, girlfriend, wife, husband, whatever
parent that can gift you the closing cost. 401k money, you got $50,000 in your 401k, you want to borrow $10,000 from your 401k?
Right.
You can borrow $10,000 from your 401k.
Or even, let's talk about people who don't have the 401k, don't have parents. Maybe they've got a significant other in their life. You need to figure out a way to put $19,000 together. And most people, I think, can do that. They just need to figure out how, and it might be a huge struggle. I mean, that might be.
I think back to myself, this is dating it, but 20 years ago, before I was in the mortgage business, didn't have any money. And that would have been, back then, that would have been tough.
Right.
I probably could have came up with $10,000-15,000 though after putting a plan together.
Right. And being dedicated and I mean, I would in my 20s. My wife didn't work, and we had 2 young kids, and I was always scrambling, even though I'm self-employed. Scrambling to get there. I would have had a hard time putting $19,000 and just having that taken out of my account, and here's my house. It takes a while, but I think you got to get there. And so, percentage-wise, what do people need to be putting away to afford that $18,000? Is it 10% of their income, maybe? I mean, that's a good gauge. 10%. If you can take 10% of your take-home pay, that's reasonable. You just have to have a budget, and figure things. What can I cut out? Right. So it'd be, $18,000. Do I need DirecTV at $100 a month? Oh, yes.
Or can I get internet TV at $30 a month?
How else am I going to watch the Seahawks? And I got to have my HBO. Okay. I got to have my Showtime.
Okay, so the Seahawks I can watch in Montana because they're considered a Northwest where I live. In Northwest Montana. I'm in Northwest Montana, Whitefish. So they're on all the time. So I mean, granted, I have Spectrum there, and then I have Sling for my internet TV.
Oh, that's your.
So I have 2 TV sources, but they're both super cheap, way less than DirecTV. So
obviously, cable is one way. Eating out less. Maybe you don't take that second vacation, whatever it is. You just do something different.
Drive a car that gets good gas mileage.
Don't have a car payment.
Car payments are
have
killers.
A crappy car.
That's right.
and just make it go.
You don't need a $25,000 car. You can get a
Right.
decent car that gets you from A to B for $5,000.
Yeah.
You know?
Maybe you don't buy that extra set of clothes in the year that you don't really need, but you just want.
Yep.
Maybe you don't buy that 100th purse.
Or you don't have to have the Bellevue Club membership. You can
What?
go to Gold's.
No. You're going the wrong direction here, Dan. I am not on board. I'm going to be a renter forever on that basis. I'm not buying a
I
home.
missed the Bellevue Club. It was
Yeah,
good.
yeah. Okay, so what other kind of things are you seeing besides the fact that the Seattle market is just not affordable for a lot of people? A lot of people making good money, but people on the lower end, what's the cheapest home that you have done financing for?
In like Pierce, Snohomish, King County, or
Sure.
yeah. I mean Pierce County probably like $350.
Yeah.
Yeah, down south there in Auburn area.
And that's probably a little Rambler.
Yeah, 1,200 square foot, 3-bedroom Rambler.
Nothing crazy.
Yeah, I've definitely done more loans this year where people are, even young millennials are like trying to get out of Seattle because there's nothing to do because it's all shut down because of COVID and stuff. So they're moving out to the certain areas of the east side. You know, some of them got money, some don't, but it just depends. Yeah, we're seeing a lot of that.
Here's my thought on that. What happens when traffic gets really bad because we all go back to the regular commute
Yep.
and everything opens up back in downtown?
Yep.
And those people all have these horrific commutes that are even worse now. How
Yeah.
long until they realize, oh man,
I moved to Sammamish and I got to work downtown.
this is a bad COVID decision I made.
Better hope that they can work via Zoom and remotely. Because if the employer changes their mind on that, that'll create more inventory because there'll be more sales.
I think that's the reality.
Yeah.
End of quarter two in 2021.
2021.
That is my
going
prediction.
into August, September. Maybe
Yep.
there's more inventory because of that.
Yeah.
Yeah.
Well, I think you just got a lot of people who are going to be like, man, why did I move here?
Yeah, because if they have to work in downtown, and you don't want to do that commute if you're not
No.
living on that side of the lake.
Yeah.
I mean, I would never. I just move to Montana
Shoot
or
me.
something. Yeah, shoot me.
Yeah. But we've got the ability to
Yeah.
kind of call that. If you aren't making the kind of money you want and your employer says, you know what, you need to come to the office 4 days a week.
Yeah.
What are you going to do? You're going to go to the office.
Yeah.
And that's in downtown. So you may have now a commute that you once thought was half an hour goes to an hour and 15.
Yeah, you're getting up an hour earlier and leaving the house by 6 a.m. as opposed to 7.
That's
You
the
know,
reality.
yeah.
I have a lot of people telling me, nah, work from home is going to be here forever. I think to a certain extent it will.
I don't know. I mean, there is that, it's nice to be able to work from home, but there is that camaraderie, that, that team environment, that
Seeing other people.
seeing other people that people are going to crave.
Yeah, because Zoom doesn't count.
No, Zoom does not
It-
count.
it's just
not
video.
the same.
No, it's not the same.
Yeah.
Yeah.
It's nice, but it's not the same.
It's a tool to use, but it doesn't replace being in an environment. And it's that creative camaraderie that I think a lot of businesses are missing
Yeah.
from doing the whole, you guys can work from home forever.
Yeah.
I call BS on that one.
Yeah.
I don't think they're doing that long term.
No, probably not.
Let's switch gears here. Did the mortgage market, did interest rates, did they have any impact from the election, or was that kind of all built in? Was there any
Good question. Yeah.
rates going up, rates going down?
Just a little hiccup for a couple days. We had a little increase there, probably about an 1/8%, and then it came back and turned itself around after about a week.
Okay, just
Yeah.
did the mortgage market kind of look at it like everybody else in the stock market? This is probably what's going to happen, and
Yep.
since that happened,
Yep. I mean,
Just
there's
kinda
still a
kept
little
on cruising.
uncertainty there, but it's not affecting the market a lot. And I think I guess just the number one reason is the massive amount of money that the Fed is pouring into the mortgage market.
it's like $80 billion a day.
It's a lot,
Right?
Yeah, yeah.
I mean,
it varies. They have a weekly schedule. Hey,
Yeah.
we're going to buy this much this week and next
Yeah.
month. But yeah,
And they're talking about going a little bit longer term
yeah.
is what they're kicking around.
I believe it'll through 2021. It'll be going down like that, where rates will be.
Let's talk about that.
Yeah.
So interest rate predictions. We're getting close to the end of
Yeah.
2020.
Yeah.
What do you see moving forward in 2021? The Fed is committed to a
Yeah.
low interest rate environment.
Yeah.
Can they control it? Can they keep it hanging in there?
I think they'll control it, and I think we'll, on a 30-year fix, right now we're saying 2.75, no points.
Yeah.
hard to imagine it's going to go much lower. So, but
we keep saying that.
We keep saying that. So I will not be surprised if we hit 2.5.
Wow.
So I'm not saying we're going to, but I think there is probably a 70% chance that we will see 2.5 within the next 3 months.
So
on a 30-year fixed.
So at 2.5%, do we have a refinance boom from all those people who bought at 3.5%?
Yeah, I mean, we're still in that boom right now. It's been going on since March.
It's been just forever.
Insanely busy.
It was before COVID because we were super busy on the appraisal end going into COVID with refinances.
Right. We were still, before COVID, we were at 3.25 roughly.
Yeah.
So I see 2021. I mean, I could see rates for a little while going up, like in the third or fourth quarter, going up to above 3, but I don't see them going above 3.25.
Are people going to panic if they go over 3?
Oh, if they do, they're not thinking straight because it's still a really good,
really low number.
Yeah, I mean, I see rates staying under 3.25 all next year on a 30-year fix. That's my opinion.
Prediction.
Probably closer to on average. Like if you took the year as an average, I would say probably 3% on average. Right. But it's it'd be interesting to watch this a year from now. See what happens. But
that's the interesting thing is that you can look back on your predictions and go, man, I blew that one.
Yeah. Yeah, because nobody can predict the future, and if the Fed changes something, or
but we can.
Yeah,
I mean, you and I.
Yeah, just the sports almanac, Back to the Future with Biff. We're making some money.
So funny. So with that, so we think we're going to have low interest rates. With that, we've got zero inventory.
Yeah,
we've got no inventory. What is our spring market gonna look like?
I call it a feeding frenzy. Imagine a lot of piranhas. They're getting another fish and they're eating it. That's what it's going to be like, I think, because we got the low interest rate. They're going to be, like, as you know, there's going to be price escalations that are crazy.
Yeah.
It's going to be, I really think, the way right now I've got several purchases already lined up closing in January. Normally January is super slow.
Dead. Yeah.
So I don't even think there's going to be, personally, I'd like to check out the last 10 days of the year because I've worked like a dog this year, and like to check out the last from December 20th through January 1st and not work at all. But I'll have to do some work.
Right.
But it's going to be crazy, especially once we get to the second week of January.
Right.
And people are back to work.
And you and I have talked about it. We're in an industry that we are super fortunate to be where we're at. Because you and I talked yesterday when we were kind of planning this podcast. We're talking about some of our friends that own bars and restaurants and small businesses that are closed, that are not doing business. 2020 has been horrific.
Yeah.
And you're talking about you've worked all year. You had a good year, right?
Phenomenal year,
And then there are other people out there who have been really suffering. And that's what I continually talk about is we need some more money pumped in to these businesses that have been under a state-mandated shutdown.
Yeah.
Those guys are not out buying homes. They are barely able to scrape by.
Some are not making it, They're shutting their doors.
That means their employees shut their doors. All their vendors no longer have that business. So there's that flip side to this whole pandemic that in real estate, we're kind of immune to because we're talking about feeding frenzies. If you got a listing on the list side of Summit, we got a listing, money in the bank.
Yeah.
Because that bad boy's going to sell.
That thing's selling quickly.
Yeah. Unless it's a studio or a one bedroom.
Yeah.
And we can't give those away.
Yeah, studio or one bedroom. Yeah, people want space.
Yeah. And I continually bring this up that if you want to do an investment that isn't popular, but I believe long term will be a really good investment, go buy that studio, go buy that one bedroom, because eventually, when everybody returns back to these
it's a good investment property to rent out. Yeah.
Yep.
Yeah.
But during the Rona, who wants to be in a studio? Let's see, you're gonna do all these living activities in 400 square feet? No, people are not.
Nope.
So you think real estate, you think our market, your market is interest rate driven.
Yeah.
My market is interest rate driven as well.
Yeah, sure. I think next year, I've been looking at projections and stuff like that. And so I rely on the experts more so than myself. But next year we'll see a decrease in refinances by probably 30 to 40% from this year. But we're going to see an increase in purchase business. I'm going to say by about 25%.
Wow.
So
do we have enough inventory for that to be a reality?
that's the problem.
I don't think we do.
Is we may not. We may not. But there's going to be that demand. So you got to figure out as a real estate agent or as a loan officer like me, how you can get more of that piece of that pie. Because there's going to be business to be had.
Yeah, but there's a half of a quarter of a slice. There's an eighth of a slice of one piece of pie that's left. It's under a month.
Yeah, but if you could it just increase as a business, whether you're an agent, real estate agent, or a loan officer like me, if you could just increase your purchase business amount by say 10%, you're getting some of that increase in business next year.
Increase in business, yeah. I mean, I guess that makes sense, but I am skeptical that we're going to have enough inventory because this is the lowest inventory market I have ever seen by far.
Yeah, the only thing that I would think is there's still that exodus happening. People are leaving Seattle, they're leaving Washington State, they're moving to Montana, they're moving to Idaho, wherever it is.
Here's what's interesting about that. I did a podcast on that yesterday.
Yeah.
For every 2 people leaving Seattle, 3 are coming in.
Okay, so that's the problem.
In migration.
Yeah, and I know there's a lot coming here, especially if you're out of college, you're young, you're under 30, people are moving here. And then there's even Californians that are just like, get me out.
Right.
I'm tired of paying the taxes.
That was kind of like you. Get me out. Like you and Joe Rogan and Ben Shapiro and a bunch of other high-flying celebrities, you included.
So there's people, there's there's people like that. Yeah, me and Joe Rogan, So yeah, I mean, there's that factor there that people. So maybe that creates a little inventory, but obviously it will get eaten up. It's just a matter of how quickly and.
Because under a month of inventory, 4 to 6 months is normal.
Yeah,
a lot of people point to 6 months as being normal. We haven't had that for years, but now we're under a month.
If we could just get to 2 months, Sean.
Yeah, we would have more
happy.
of a normal market. But with COVID and coming out of this current eruption of cases, Washington had 3,500 cases yesterday.
Yeah.
Those are big numbers. Even if you think that COVID is a hoax, you got to look at that going, all right, even if they're cooking the books on half those numbers, that's still a lot.
If they're cooking the books on half, that's still a lot, And you got to think, like I read an article the other day in local Flathead Valley paper. Flathead Valley is a pretty big area. It's about 110,000 people there. Guess how many people have moved there, whether they're second homers or full-timers, in the last 6 months?
I don't know.
30,000.
I was going to say 20.
30,000.
30,000.
So you're up 30%. You're up 30% of your population
in 6 months.
In 6 months.
So your infrastructure is going to be hard pressed to keep up with all that.
Yeah.
I mean, your police, your utilities, housing. I mean, that stuff is just all.
Now, some of those people are half the year there, 6 months, but some are full time.
Right. Yeah. The dynamics they're changing.
They're a little
for
different.
Sure.
Yeah.
I did a podcast on New York, the exodus from New York. About 1 million people have left New York City.
That's a lot of people.
Since COVID. 1 million.
So that's what, 5%, maybe 7%?
Somewhere in there, yeah. But if you think about it, they all live in an enormous high-rises or high-rises. And the only way to get around is really public transport. Mm-hmm. Get me out of there.
Yeah, because if you live in Manhattan, you're not driving around.
You're not driving.
No.
You're taking subway.
Subway, or if you can get an Uber, I don't know.
Yeah. But, I mean, Ubering everywhere isn't really a reality.
No.
Because traffic is so bad.
Yeah, the subway system in New York is actually the way to go.
And so do you want to hop on the subway in New York City where you've got massive cases of COVID?
It's everywhere.
Even if you think it's a hoax?
Yeah.
No, I don't. Yeah. And that's why so many people are leaving.
Yeah, right.
And they're trying to get out. Same thing with San Francisco.
And all the restaurants are closed down and whatnot.
Yeah, all the cool stuff is closed down.
I mean, New York's a great city if you can do stuff. But if you can't, it's boring as hell.
How about Times Square? Would you go to Times Square right now?
Yeah.
There's nothing going on.
There's nothing there. Yeah.
No. So that's where I think you're going to see a big change in a lot of this when we get the vaccine out, whether you choose to take it or not. Mm-hmm. That'll be there mentally for people. And so I think the end of Q2 in 2021 is when we start to see some changes, start to kind of see that wave go the other way, which is employers bring their employees more back into the downtown.
Yeah.
There's less fear.
Yeah, right.
And I don't know if you've sensed it since you came in from Montana to Seattle here last night
Yeah.
or yesterday because I was talking to you on the phone.
Yep.
I don't know if you've noticed driving around since the last time you were in town. A lot more people running around right now.
Yeah.
We're pre-holidays.
Yeah.
People are out doing stuff.
Yeah.
They're not hunkered down at home.
Yeah, no, I mean, driving through 𝒆💂💂 and Bellevue and Kirkland yesterday, that traffic hour was it was full.
It was full.
The roads were full.
Yeah.
Pretty full.
It's not like traffic was pre-COVID,
Yeah.
but there's a lot of people.
Yeah, I mean, I was here this last summer too, and it was busy, but not. It definitely seems a little more busier now, a little bit.
For sure.
Yeah.
Yeah. I think people are like, all right, I can't stay at home forever.
Yeah.
I'm going to wear a mask.
Yeah.
I'm going to go do my thing. This is where we're at.
Yeah. You know, you probably still have people that go into the office. They just have to wear a mask or whatever when they're in the office.
Yeah.
You know.
Yeah. I mean, that's just
People have gotten used to that, right? They've gotten used to it.
You stick your mask on. You always take, even when I go for a walk now, in case I need to go into a store or something,
Put it in your pocket.
throw a mask in your damn pocket.
Yeah, yeah.
And just have it there.
Yep.
So,
Yep.
Dan, thank you so much for coming on. I think we've covered everything. We've beaten these topics to death. I really appreciate you coming on because now I can say to a lot of my brokers, hey, just did a really good podcast on this. If you guys want some basic information to give to your clients, to your buyers, or if you know somebody that's trying to buy a house, here's a really rough estimate of how much money you need. Here's how much your payments are going to be.
Yeah.
Here's how much money you need to make, kind of thing.
Yep.
So thanks for sharing all that.
Yeah, you're
info.
welcome.
Yeah, yeah.
Thanks for having
me. And hopefully you get some business out of this.
Yeah. Awesome.
Yep. All right.
Happy
Thanks again
Thanksgiving.
happy Thanksgiving to you, Dan. We'll catch you in the next one.
Sounds good.
All right.
Thanks,
you.
Sean.
Yep. Bye-bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.